Welcome to Entrepreneurial Edge. Let's talk about your savings account. It's something almost everyone has, and it feels like the safest place for your hard-earned money. You work hard, save your money, and trust that it's secure in the bank. It's comforting to see your balance grow, even if it's just a little at a time. But here's the truth. Holding too much cash is actually a huge financial mistake that many people don't realize they're making. Inflation is the silent thief. Your money loses value every single day it sits idle in your account. Prices for groceries, gas, and everyday items keep rising, but your cash doesn't keep up. Even with interest, most savings accounts don't come close to matching inflation. That means you're actually losing purchasing power over time, even if your balance looks the same or grows a little. Think of your cash as a leaky bucket. No matter how much you put in, inflation keeps poking holes, slowly draining away your wealth without you noticing. Cash is still essential for emergencies. Make sure you keep 8 to 12 months of living expenses liquid and safe, so you're prepared for the unexpected. Use cash for short-term goals, like a down payment you'll need soon, or any big purchase coming up in the next year or two. But for long-term goals, like retirement, your child's education, or achieving financial freedom, your money needs to work for you. Letting it sit idle means missing out on growth and opportunity. Don't let your future leak away. Make your money grow by investing wisely and letting compound interest work its magic over time. So if cash isn't the answer, what is? Productive assets. Warren Buffett built his fortune by buying assets that generate more money over time, like stocks. When you buy a stock, you own a piece of a real business that creates value and earns profits. As the business grows, so does your investment. Many companies pay dividends, extra cash just for being an owner. Reinvest those dividends and your wealth snowballs. Productive assets, stocks, businesses, real estate, work for you 24/7. Stop thinking like a saver. Start thinking like an investor. Buffett didn't get rich by hoarding cash. He bought great businesses and let them grow. That's the path to real wealth. You're ready to invest, but with so many options, which stocks should you actually choose? Don't chase hot tips or buy just because something's cheap. It's easy to get caught up in hype, but that rarely leads to lasting success. Warren Buffett looks for wonderful companies with a durable advantage, brands, technology, or a market position that competitors can't easily beat. These are businesses with a moat that protects them from rivals. He wants strong management, consistent profits, and products or services people will need for years to come. These are signs of a business built to last. The best time to buy these companies is when they're temporarily undervalued, when the market is fearful and prices drop, but the business remains strong. Remember, cheap doesn't mean a low price per share. It means buying for less than the business is truly worth. Focus on value, not just price. For example, a $300 stock can actually be cheap if the business is worth $400 or more. It's about the gap between price and value. Always focus on quality first, price second. A great business at a fair price beats a mediocre one at a bargain. Do your homework. Understand the business, its industry, and its future prospects. The more you know, the better your decisions. Don't try to time the market perfectly. Instead, be patient and take advantage of opportunities when great companies go on sale. Quality plus value is your ticket to building real wealth over time. This is the foundation of smart investing. That's how you invest like Buffett, by focusing on quality, value, and patience. Picking stocks isn't for everyone, and that's okay. Most people should invest in low-cost index funds, like the S&P 500. With one purchase, you own hundreds of top companies and get instant diversification. Buffett himself recommends index funds for most investors. They're simple, effective, and protect you if a few companies stumble. Real estate is another powerful asset. Rental properties provide steady income and long-term growth. You can even build wealth by owning your own business. The key is diversification. Mix index funds, a few quality stocks, maybe real estate or a business. Multiple streams of income and growth build a financial fortress. Don't put all your eggs in one basket. Spread your risk and watch your wealth grow. The secret sauce to building lasting wealth? It's compounding, one of the most powerful forces in finance, yet often underestimated. When you reinvest your earnings, whether it's dividends, profits, or interest, you set your money in motion, allowing it to snowball and multiply over time. At first, growth may seem slow, almost invisible. But with patience, it accelerates dramatically. This is the foundation on which fortunes are built. Remember, consistency always beats trying to time the market. Commit to investing a set amount every single month, regardless of market ups and downs or headlines. This approach is called dollar cost averaging. It helps smooth out the market's volatility and keeps your emotions in check. Forget chasing get-rich-quick schemes. They rarely work. True wealth is built through discipline, patience, and steady investing in productive assets that grow over time. Build a portfolio tailored to your goals and lifestyle, so one day, your money works for you, not the other way around. Always keep enough cash on hand for emergencies and short-term needs. Invest the rest for your future. This is your entrepreneurial edge, your unique path to financial freedom. You now have the knowledge and the tools. The next step is yours. Take action. Start today, stay consistent, and let the magic of compounding quietly build your future wealth, one step at a time. Like and subscribe for more practical strategies to help you own the life you truly deserve.